Welcome to Yahoo Finance Live in our crypto special, Crypto Collapse. It is 11 a.m. on the East Coast, 8 a.m. here in the West. I'm Akiko Fujita, joined by Brian Sazi and Brad Smith. Over the next hour, we're going to be diving into the global impact of FTX's bankruptcy and how the turmoil could affect your investment in this space. First, though, here are some of the top stories that we are watching at this hour. Major crypto assets pushing higher as Binance's head CZ says the exchange is planning an industry recovery fund. This after halting deposits of FTT tokens and singling out what it describes as bad actors in the space.
FTX founder Sam Bankman-Fried appears to be in the Bahamas as authorities say they are investigating potential criminal misconduct. This amid speculation of a separate SEC probe.
And as reports swirl that FTX lent customer funds to its troubled Alameda unit, we ask how destructive this is for crypto. We're going to put that question to MicroStrategy's Michael Saylor. He joins us imminently.
So let's begin this hour, guys, with where we are and how we got here. Signs of trouble for FTX began when CoinDesk first reported a leaked balance sheet of Sam Bankman-Fried's Alameda research trading firm. Now, that showed it was heavily dependent on FTX's native token, FTT. A few days later, Bankman-Fried reassured customers in a now deleted tweet that FTX and its assets were just fine. But one day after that, Binance announced its intent to buy FTX because of a liquidity crunch. Now, that was last Tuesday. The decision, as we know now, was short-lived. Later in the week, Binance said it was walking away from the FTX deal, leading to FTX filing for bankruptcy in the U.S. That was on November 11th. Now, given the turn of events with FTX, Binance's CEO has now announced in a tweet that the crypto exchange will help, in his words, reduce further cascading negative effects of FTX and form an industry recovery fund. As for FTX, police in the Bahamas, where the company is headquarters, has said they are working with the country's securities regulator to investigate FTX for criminal misconduct. A person familiar with the matter has confirmed to Yahoo Finance that the law enforcement there are forcing Sam Bankman-Fried to stay in the Bahamas as of Saturday night. And Brian and Brad, that's kind of where things are right now. You know, in many ways, when you look back to where things were a week ago, this, you know, for all the talk about the technology and where crypto is, this kind of played out like a traditional bank run. And we had a major player in the space collapse in a significant way. And then since then, we have seen this contagion effect where so many exchanges have come out and said, we are not the same as FTX, even as customers have gone in and started to withdraw funds.
You talk about just weeks ago, we think back to over the summer as well, even as there was this crypto washout or the emergence of the crypto winter that was solidifying itself. We had been looking at Sam Bankman-Fried as almost a savior to some of the other crypto companies, looking at how he could make sure that they were getting some type of float that they would need necessary in order to just get through this crypto winter. Now there's larger questions of if there was some type of wrongdoing and even how he was looking to drum up or write up what could be the future of the boundaries and the stakes for the law in crypto as well, as he was working with SEC Chair Gary Gensler on that. Larger question on where the tires are going to be kicked on that and the type of scrutiny that we could see come forward. But this was a far different story over the course of the summer for Sam Bankman-Fried. But the fact that FTX was only looked at by Binance for less than 24 hours almost says everything that you need to know about how much wrongdoing had perhaps persisted for whatever the extent of time was. But Binance quickly stepping away. CZ also doing an Ask Me Anything today about this too.
I would say he's really rubbing in here, Brad. But the theme all morning long, really, as we were talking about in the 9 o'clock hour, is this trust. What reestablishes trust inside the crypto industry? What do we need to see? A lot of folks that we've been talking to suggest some form of regulation will help reestablish that trust. But Akiko, regulation, as we all know, does not happen overnight, which raises the question, what rebuilds that trust and what gets prices ultimately headed higher?
Absolutely.
Yeah, I mean, as you pointed out, Brian, it really is sort of a crisis in confidence right now that's playing out. And that's why you've got so many CEOs in the crypto space coming out and saying, here's where a balance sheet looks like. Here's some more transparency, because if you are a holder in crypto, you're wondering what's the next domino to fall.
Well, to break down all of the crypto price action amid the fall of crypto exchange FTX, we've got Yahoo Finance's Jared Blickery standing by with some key timelines that we should be watching as well over the course of this.
Yes, no need to rehash the entire thing here. I have a number of points on this 12-day chart. This started about a week ago last Wednesday, and indeed it was with the revelation that FTT tokens were making a sizable sum of part of the balance sheet of some of these affiliated enterprises that we're talking about. But over the weekend, some interesting things, revelations regarding crypto.com. There are concerns all over the place. What do these companies have? What do these exchanges have? And there was it came to light that 400 million and change in Ether were transferred out of crypto.com in late October. They recovered it. It was a mistake. And Chris, the CEO, saying the Ether transfer that generated so much FUD on speculation on Twitter today were made over 3 weeks ago on October 21st to whitelisted corporate account Gate.io. And they say that there are more proof of reserves coming, but just goes to show you the maelstrom that the industry is in. And then we got a nice rise off of this. We were talking about the tweet from CZ saying to reduce cascading negative effects of FTX, Binance is forming an industry recovery fund to help projects who are otherwise strong but in a liquidity crisis. More details to come. Well, we're going to wait for those details, but with no backstop, no central backstop existing in crypto and a lot of trust missing from the enterprise, it's going to take a long time to recover these losses. Real quick, just want to draw everybody's attention to the last crypto winner. Peak was in December of 2017, took 3 years to take out that high. We're about 1 year in from that peak, guys.
Jared Blickery, thanks so much. All right, it has been an eventful couple of days for cryptocurrencies, to say the very least, as the ripple effects of the FTX crash make their way through the wider market. Despite this, some crypto bulls are staying put. Our next guest might well be the most high-profile Bitcoin champion of recent times, and he's still beating the drum, saying Bitcoin might well come out on top. We're happy to be joined by Michael Saylor, MicroStrategy founder and executive chairman. Michael, always nice to see you. You heard Jared talk about this recovery fund being put forth by CZ. What are your thoughts on that recovery fund, and does that help to rebuild trust in the industry?
I think that Binance is the best managed and, of course, the most well-known of the crypto exchanges. But the most important point to be made here is the collapse of FTX and FTT represents a corrupt crypto bank collapse fueled by an inflationary fiat cryptocurrency. So, as Gary Gensler has said, the vast majority of all the cryptos are unregistered securities. They're trading on unregulated exchanges. Proof of stake tokens are backed by nothing, which is why FTT could be printed into the $8 billion zone. And this is simply a very expensive lesson for the crypto ecosystem and the difference between crypto and Bitcoin.
Michael, we've just recently seen Bitcoin come off of its 52-week low, but it's also winter low in terms of the price action here. And so with that in mind, do you believe that crypto whales are looking at the price right now and still seeing some type of opportunity? And what type of concentration among Bitcoin ownership do you think, even at these lows, which are still amid a washout in some of the confidence for other investors in crypto, what does that mean in terms of the concentration of ownership going forward?
I think it's another event that's massively distributing more Bitcoin all around the world. I think there's a massive amount of accumulation of Bitcoin right now. The BTC is moving from weak hands to strong hands. I think this is one of those annealing events. 2.5 years ago, in March of 2020, we saw a similar circumstance with Bitcoin trading in the $4,000 range. If you look at the volumes of Bitcoin trading today versus then, they're up by a factor of 5 to 10x. So there's extraordinary institutional interest and investor interest in the asset class. And I think that this is going to be really helpful for Bitcoin because this is an educational moment and people are realizing the benefits of buying a crypto asset that's backed by the world's most powerful computing network and by 10 gigawatts of energy. And the difference between that and the 20,000 other cryptos that are in essence backed by nothing, and they're just like other fiat currencies.
So, Michael, let's pick up on that point. I mean, it sounds like you're saying there's going to be real divergence here between the likes of a Bitcoin or an Ether versus some of these other digital tokens. What does that shakedown look like? And ultimately, how many of those tokens survive?
Well, I think this crash accelerates regulatory intervention. I mean, in fact, in a sense, right, SBF is like the Jordan Belfort of the crypto era. Instead of the Wolf of Wall Street, they'll make a movie called The King of Crypto. This is going to bring in the SEC, the CFTC at a much greater rate. And the future of the entire industry is digital assets trading on registered digital assets trading on regulated exchanges. So to the extent that there's something good in the crypto industry, the good stuff is a digital exchange that trades 24/7, 365, trading on 8 billion Android and iPhones, digital currency available to Argentinians and Lebanese and people all through Africa and Asia that are blocked from the US financial system. The ability to issue tokens if you're a creator and monetize your brand. And the ability to deliver digital securities that trade 24/7, 365 at the speed of light, friction-free, outside of the traditional banking system, which is in essence a monopoly on assets. So those are the good things. The problem is those have been pursued by the crypto industry in an unethical, unstable, technically irresponsible fashion. And this is just highlighting the fact that a good idea pursued in an unethical, irresponsible fashion is a bad idea. I think that the regulators have it right. The idea is you should be able to register your digital asset. If you have a stable coin, you should register it with the SEC. If you have a security, you should register it. If you want your crypto token to be designated a commodity and an asset without an issuer, you ought to have a registration process. And if you want to run a digital exchange that trades all these tokens, you should be a regulated, transparent exchange that's trustworthy. And I think the regulators get it. I think the politicians get it. I think it's been a very expensive process going through Terra and Luna and Celsius and Three Arrows, and now FTX has collapsed. But at this point, I don't think there's anybody in the Western world that doesn't understand the risks of allowing people to promote unregistered securities on unregulated exchanges. And so what's going to happen? You're going to see a massive shakeout. 99% of these air tokens are going to go away. They're literally the penny stocks of our era. The joke, of course, is penny stocks used to trade for a nickel, whereas some of these dog coins are trading for fractions of a penny. They're not even penny stocks. At one point, they created a token which was 0.00001 cent, so that you couldn't even read the price of the token on an 8 significant digit display on a crypto exchange. So that stuff's got to go. And what needs to replace it is ethically sound, technically sound, economically sound digital assets. The industry needs to grow up.
Michael, as a statesman in this industry, those words, comparing SBF to a Jordan Belfort, those are some big words here. So is there another way to look at it in that you view SBF as a corrupt player in this industry and he needs to be made an example of, put in jail for what he has done to the space?
He was using counterfeit money and stolen money to lobby against all the virtues in the industry, against proof of work, against Bitcoin. He was working to corrupt regulations, corrupt the political process, right? When you have actors that use corrupt, counterfeit stolen money in order to undermine the industry, it's not good for anybody. And so, yeah, I think that people need to decipher this. FTX, generated an FTT token. If you trade your own token on your own exchange with wash trading, with leverage, you can park the price at any number you want. So you want to make $1 billion, you jack the price by $3 by wash trading with yourself. Then you generate $1 billion of collateral. Then you look for a bank that'll loan you money against the collateral. And of course, nobody in their right mind should be loaning money against an air token that you manipulated yourself. But of course, Sam happened to be the CEO of a bank that made loans. So he applied for a loan from his own bank and he granted it to himself. And then he took real assets like Bitcoin from his honest customers. And then he rehypothecated them, traded them, lost them. And so this is just an egregious ethical lapse, and it can't go on. These exchanges cannot continue to be unregistered, unregulated offshore.
And a lot of those customers this morning wondering whether they're going to get their money back. Michael Saylor, it's great to have you on this special today. Michael Saylor, MicroStrategy founder and executive chairman.
Yeah, thank you for having me.
Well, coming up, predicting the crash, our next guest may have had a crystal ball at home. He was way out front warning about the troubles at FTX. BitBoy crypto founder Ben Armstrong's been joining you, Beth, after the break.
We think the single most important thing is that we do backstop the industry, and that is paramount. And we'll do what it takes to do that. But yeah, ideally, other people would be joining in that with us.
That was FTX founder and former CEO Sam Bankman-Fried's response back in July on Yahoo Finance to the criticism that his exchange was getting too big. And this is the saga develops. We've been hearing about the impact to other players in the industry. For more, let's get to our very own crypto reporter, David Hollerith. Dave.
Brian, so we can sort of think of FTX's whirlwind collapse as having sort of two kind of effects on the crypto market. The first is, given its bankruptcy, there's 130 affiliated companies, and most of those look like shell companies. We're not really, it's not really clear what they could be holding at this point. But as far as direct exposure, we have the venture investors that have had an equity stake in FTX, and that included Temasek, Sequoia Capital, the Ontario Teachers Pension Fund, and then crypto-specific VC firms such as Paradigm, Multicoin, and others. So while perhaps these entities have probably taken the largest amount of losses in terms of their investment into FTX, outside of the crypto-specific firms, there's still a pretty low exposure in terms of the losses they're going to see relative to their other investments. And then we have the firms that specifically traded on FTX and held their cryptocurrencies on the platform. As far as that goes, we have Genesis Trading, CoinShares, Galaxy Digital, Wintermute, which was a market maker, Crypto.com, another company called Matrixport, and the hedge fund Galloy Capital. And those funds are going to be stuck on the platform, and they range anywhere from a couple $10 million to $100 million. So it's not enormous for these companies, but again, they're smaller. And also, I want to point out, just given the bankruptcy process that it's expected to carry on for, potentially years, it might be a point where a lot of these firms may want to sell the claims on their assets early so they can get out of the bankruptcy, sort of free up the capital they could get maybe from a discounted claim. And then, there are some smaller tokens such as Serum, which for the Serum project, which was revealed as being heavily owned on FTX's balance sheet. And so that sort of comes back to the fact that a lot of people are seeing these smaller tokens that FTX and Alameda held onto. And, essentially the amount of selling they're going to have to do is going to rock the token price and make it untenable. These are tokens that are, their market cap is only a couple $100 million. But then, if we move on, there's Voyager Digital and BlockFi. Voyager is in bankruptcy right now, but FTX was going to purchase their customer assets for $1.4 billion. It can be assumed that that deal is off the table. Voyager Digital has already announced that it is sort of reopening bids for selling its customer assets, and that is still sort of developing over the weekend. Then we have BlockFi, the crypto lender which FTX lent money to over the summer. BlockFi paused withdrawals on Thursday, and since then they've sort of remained silent. They've not been open for comment, but they're not appearing on the FTX bankruptcy, but it can be expected that they're facing issues, and we'll be hearing something from them very soon, if not sometime today. And then the second point goes more to this issue of trust that crypto exchanges, I want to point this out, centralized crypto exchanges specifically, companies that are managing customer funds, crypto assets, they're sort of dealing with this broader issue of a blow to trust from customers. And a movement that we've seen since Friday has been for companies to publish their assets, or at least customer assets, on the blockchain as sort of a way to prove their transparency. So I wanted to point out too that Crypto.com, in doing this, has seen its own sort of shortfall. After they published their wallet address, it was revealed that in October they made sort of a mistaken transaction, about $405 million back in October to another crypto exchange. Crypto.com's own exchange token has actually seen, about a 24% decline since that has sort of come out on Saturday. And in sort of an emergency AMA, the company's CEO talked to investors and customers this morning, and here's a little bit of what he had to say, and it sort of echoes what's going on with centralized crypto exchanges right now.
If you look at the nature of the business, it's really very simple. Give access, charge a fee. We never engaged as a company in any irresponsible lending practices. We never took any third-party risks. We do not run a hedge fund. We do not trade customers' assets. We always kept one-to-one reserves, and it's also true today, and very soon we'll prove it with the audited one-to-one proof of reserves.
That was the CEO of Crypto.com. While we all bore witness to the collapse of FTX last week, our next guest almost predicted what was going to happen days before. On October 29th, he tweeted, "If you don't close your FTX account today and get your funds off that exchange ASAP, I'm sorry, but you are the definition of low IQ and deserve what's going to happen to you." And 2 weeks later, after everything unraveled, FTX CEO Sam Bankman-Fried told his clients he was, quote, "really sorry we ended up here." Let's bring in BitBoy Crypto founder Ben Armstrong. Ben, what information led you to conclude what was happening ahead of time?
Yeah, so it's just very interesting the way things unfolded. I was just kind of in the right place at the right time is how things shook out. Basically, I have a bill we're trying to get approved in Congress. We're still trying to get some funding for it so we can make it public. And we reached out to FTX for funding because we thought maybe their ideals aligned with ours. And basically, through a long series of events that went through SBF to Tim Harrison to Wetjen, the former CFTC guy that was their policy head, and they actually tried to steal one of our political backers and actually communicated that they were trying to do a federal bit license. So like, that's kind of weird. Federal bit license, the worst legislation ever in the history of crypto, totally benefits centralized exchanges, gets rid of decentralization, gets rid of peer-to-peer, peer-to-peer transactions because you wouldn't have a license, which the license costs hundreds of thousands of dollars to get, of course. And so I started saying, man, there's got to be something to this. Well, lo and behold, about 4 weeks after I came out with what they were doing, suddenly he comes out with this manifesto, SBF, leading to the idea of licensure. And suddenly people started listening. Oh my gosh, we think Ben actually knows what he's talking about. And all of his enemies, all the enemies that SBF has had over the last, 2 years, started sending me messages. And we just started learning of more and more and more that they have been doing on the backside to completely destroy projects like ICP, projects like Refinance, projects like New Genesis, projects like Aptos, projects like Casper. These were all projects that FTX and Alameda specifically set out to destroy by making them promises to list on the exchange and then shorting them to zero by, like Michael Saylor was talking about, counterfeiting coins on the exchange to control the supply. So once we started digging into this and realizing what was going on in the back end, we tried to warn everybody. Millions of dollars left FTX. Thousands of accounts were closed because of the message we were putting out. And that tweet looks a little callous now, knowing everything that's happened. And we certainly, our heart goes out to people that lost money, and certainly people don't deserve to lose money. But anybody who heard the message that we were putting out and ignored it, unfortunately, I just hate to tell you, I wish you would have listened.
I mean, Ben, the question since last week has really been, how much of this was intentional misleading fraud? How much of this was FTX, Sam Bankman-Fried, getting over in his head? It sounds like you think it's the former.
100%. All of this is fraud from the very beginning. If you really start looking into Dan Friedberg, this is the guy to look at. This was the general counsel of FTX. Literally, he is caught on a recording discussing the counterfeiting of tokens. Now, how did Dan Friedberg even get to be the general counsel of FTX? It's insane. If you look back to the very beginnings of the 2000s, when online poker first blew up, the biggest poker scandal in history was the Ultimate Bet God Mode scandal, which players could actually see. They used the software to see the cards of other players. Guess who is the architect of all of the shell companies and all of everything that involved getting promoters, the millions of dollars that were stolen? Who's in charge of the whole thing? Dan Friedberg. How did he not lose his license after that? No one knows. Nobody knew that this was the guy that was, the general counsel for Sam Bankman-Fried. This shell game was set up so early on that it had the back end to where Alameda could go in and borrow customer funds whenever they wanted to. It only became a problem when prices started going down and they started getting liquidated in certain places and could not replace the assets. This has been a scam from day one. SBF never once had any good intentions. And there are people who say, they feel sorry for him. No. He showed no mercy to the projects that they set out to destroy, that it spent years and years building tech, years and years getting things ready for them to have a successful launch, and he destroyed them and shorted them to zero, and then he would pay them hush money so they never would say anything.
Ben, what's the next shoe to drop here?
Well, the next shoe to drop is over the next month, there's going to be a big story coming out basically exposing the entire industry. Look, 95% of what we've seen in crypto over the last 2 years has been completely fake. The market making in this business is the real dirty secret that people don't want to acknowledge. When coins sign up to get listed on an exchange, they agree to a package, and we know this from contracts we've seen from FTX, to where they're signing up for a market maker. What is a market maker? It's someone that comes in and guarantees to keep the coin between a certain range. It will not fall beneath this point into irrelevancy because the market maker will keep it propped up. Well, that's fraud. That's wash trading. That's faking volume. And that's what almost every single project has been either knowingly or unknowingly guilty of when they listed on exchanges like FTX. And of course, plenty of other exchanges use it as well. I think Michael Saylor, I love Michael Saylor. He's, we disagree on a lot of points, but he's been on my show. Certainly somebody I admire and look up to. What he's talking about the regulated exchanges, this is so crucial. Gary Gensler has completely screwed everyone in crypto. Everyone who lost any money in Celsius, Voyager, BlockFi, FTX, you lost it because of Gary Gensler. His lack of creating clarity and regulation in the space is exactly what has led us to all these offshore companies that do not operate in the United States and are not regulated. His willful lack of, dereliction of duty is what's led everybody to this point. We want regulated exchanges, but we can't get regulation. We can't get clarity. You can't do everything by enforcement. And Gary Gensler is the most negligent person in the entire space. And I blame him more than I even blame SPF.
BitBoy Crypto founder Ben Armstrong, thanks so much for taking this time and really laying all of this out as we put some perspective around this too. Appreciate it.
Thanks for having me.
Definitely. Guys, coming up, calling for change. The fintech behind the USD coin wants transparency and accountability for the crypto industry. Is it too little, too late? We speak with Circle's CEO next.
Staying with the wider crypto fallout, since FTX filed for Chapter 11 bankruptcy protection last week, other industry heavyweights have been vocal about their position in relation to the exchange. Coinbase, for one, has said it has minimal exposure to the company and none to its native FTT token. Goldman Sachs cut its price target on the stock Friday, but said it is, quote, sufficiently insulated from the fallout. Now, fintech group Circle also weighing in. That's the firm behind the USD coin. CEO Jeremy Allaire took to Twitter to say the company has never given loans to FTX or Alameda. He's been calling for greater transparency and accountability for the wider industry. And we're lucky to have him on with us today. Let's bring in Jeremy Allaire along with our very own David Hollerith. Jeremy, let's get to the very point that you have been really raising for a while. It is these offshore exchanges that you say just are not under the same scrutiny that American ones are. Does this put exchanges like Coinbase in a stronger position now?
I think that companies that are principally operating out of the United States and have subject themselves to both state and federal supervision should be, and I think are, advantaged in this phase of the market. And I think when you look at the requirements of running a national scale financial institution or a global scale financial institution in a regulated capacity, there's just fundamental things that you have to have in place around your financial controls, your risk controls, the amount of scrutiny that you have and examinations that you have around your business. And American regulators are among some of the strongest in the world. Coinbase obviously is a publicly listed company. Circle is in registration with the SEC and is a public filer. And I think that whether you're an institution or an individual, whether you're thinking about what exchange to be using, what wallet to be using, or what stablecoin to be using, you're going to be looking for the rigor that goes into being a regulated American financial institution. And I think that is going to strengthen companies like Coinbase and is certainly going to strengthen companies like Circle as well.
And Jeremy, if I have it correct, back in July 2021, Circle actually joined FTX's Series B. And obviously a lot has changed since then. And Circle is by no means alone in investing in FTX. But I was curious about sort of the conversations going into that process, what the due diligence process looked like. What was the impression on Circle's end about FTX at that point?
Yeah, so Circle has a venture investing activity. We invest very small amounts in a lot of different companies across the broader digital assets ecosystem. I think we've made about 100 investments. The investment in FTX was a very, very small investment. We are by no means a lead investor. We were not leading any kind of diligence activity in the company, more of a passive add-on investor on a very small scale. So we're not really a principal, as I would say, in those kinds of activities. But what I can say is, I think at face value, the numbers that FTX was putting up and the growth that they were demonstrating in FTX's business and their emerging U.S. business were incredibly impressive. I think those are known. And that was certainly during a time of significant growth in this industry. I think not having visibility into the underlying financial management, risk controls, treasury management, and other things, certainly has caught everyone by surprise. But it does, I think, suggest that companies that are, controlled by single shareholders, that lack boards of directors of any substance, that are not subject to significant and strong supervision on a cross section of major control issues, introduce significant risk. And there are major reasons why in the United States financial system, there are market conduct rules that deal with conflicts of interest. Banks can't run exchanges. Exchanges can't run market-making businesses. These separations have grown out of the fact that these conflicts of interest can create major issues. And that's above and beyond just the fundamental kind of risk management and supervision side of this.
Jeremy, a broader question here. This idea of a decentralized financial system with blockchain technology underlying it. I mean, this is something that came out of the financial crisis that really exposed just how much power was concentrated in the traditional financial institutions, how much the opaqueness existed. I mean, this is a system that was supposed to offer more transparency. Does that argument still hold in light of what has played out?
I think it does. I mean, the irony here is that some of the biggest institutions, financial institutions that have been built up in the crypto space are these very centralized, opaque, most of them operating offshore without any real regulatory supervision. And frankly, most of them focused on creating platforms for speculators and creating platforms that are fundamentally focused on people who are speculating on digital tokens. And so that is certainly not what the promise of this technology represents. When I founded Circle with my co-founder over 9 years ago, we were focused on how do we take traditional money like dollars, create digital currency versions of that, how to operate that on these public, open, transparent networks, create a more efficient, inclusive, transparent, and auditable financial system. And we're still making great progress towards that. But I think it underscores the need now more than ever to focus on pivoting from this speculative value phase of crypto, which has produced some spectacular gains, but also some spectacular failures and losses, and move on to the utility value phase, which is so critical and which builds on that fundamental anchored philosophy around building a public, transparent, and auditable financial infrastructure on top of these blockchains.
Well, Jeremy, it's good to get your insight today. Really appreciate the time. Circle CEO Jeremy Allaire joining us alongside Yahoo Finance's David Hollerith.
Thank you.
Well, coming up next, authorities in the Bahamas are investigating potential criminal misconduct around the implosion of FTX. What does that mean for Sam Bankman-Fried? We'll discuss after this break.
having regulatory clarity definitely helps. But it's not to say that all regulations could be good. We have to look at the specific regulation. Given the level of sophistication and maturity of the U.S. regulators, I do believe that having regulatory clarity will actually ease adoption.
That was Binance CEO CZ discussing regulation for crypto in late September. He's long been seen as a rival to Sam Bankman-Fried and has now floated plans for a crypto recovery fund. Now to the issue of potential criminality. Police in the Bahamas are working with the nation's Securities Commission to investigate whether there was any criminal misconduct in FTX's collapse. Let's bring in Yahoo Finance's Alexis Keenan, who's covering the legal angle for us this morning. Alexis.
Hi, Akiko. Yeah, so Bloomberg is reporting that Bahamian authorities, as well as legal enforcement authorities around the globe, they want to know why approximately $477 million in unauthorized withdrawals flowed out of FTX within 24 hours of the exchange, as well as its U.S. counterpart, FTX US, as well as 138 related entities that filed for Chapter 11 bankruptcy protection on Friday. Why that outflow happened just within hours of that bankruptcy filing. FTX also issued a statement saying that to comply with Bahamian regulation, that they had begun to facilitate the withdrawals of Bahamian funds. But on Saturday, the Bahamas Security Commission, it said it had not facilitated that, had not direct those withdrawals of those funds, saying that they did not explain to FTX that it wanted to prioritize in any way those withdrawals for those particular clients. Now, beyond the jurisdiction of the Bahamas, there's also speculation that FTX, as well as its founder, Sam Bankman-Fried, could face criminal charges also in the U.S. The Wall Street Journal and Reuters both reporting that the U.S. Attorney's Office in Manhattan is looking into reports that FTX lent customer funds to Bankman-Fried's hedge fund Alameda Research, which Alameda then traded to used to trade its funds. So without all of that, without customer consent, that if that is the case, and we don't know right now if that's the case, it would violate both U.S. securities law as well as FTX's own customer agreements that specify how the funds will be treated. In other words, whether the exchange will be able to lend out those funds and use them for their own purposes, or whether they need to be excluded and set aside specifically for customers to be able to withdraw and use to their liking. Now, legal experts say that gaining jurisdiction over Bankman-Fried as well as over FTX shouldn't be too big of a hurdle if there is just some minor contacts with the U.S. They cite things like emails that could have gone through the U.S., as well as even just banking transaction that touch U.S. banks. Also, Bankman-Fried known to have frequently come to the U.S. We've watched him talk to lawmakers. He's been on Capitol Hill for lengthy discussions over the years. So those things could all give prosecutors here, if there is something to go on, ability to gain jurisdiction over both. There is also an extradition policy in place with the U.S. and the Bahamas, where extradition is certainly possible. Akiko?
Alexis Keenan with the latest legal developments. Thanks so much for that. Well, coming up, a bridge over troubled water or a bridge too far? A look at what happened in meetings between SEC Chairman Gary Gensler and FTX's Sam Bankman-Fried. That's coming up.
public right now would benefit from investor protection around these various service providers, if you wish, the exchanges, the lending platforms, and the broker dealers. So we at the SEC are working in each of those three fields, exchanges, lending, and the broker dealers, and talking to industry participants about how to come into compliance or modify some of that compliance.
That was SEC Chair Gary Gensler back in July in response to what we could expect from the commission in the coming months on the crypto regulatory front. Well, amid the fallout from FTX, we are getting conflicting reports about the outcome of meetings between Gensler and Sam Bankman-Fried. For more on that, let's bring in Jen Schomburger. And Jen, we're talking about a meeting that reportedly took place before FTX filed for bankruptcy.
Good morning, Akiko. The investigations and regulatory fallout certainly heating up in the wake of FTX's bankruptcy, with lawmakers sharpening their teeth to pin this debacle on the Securities and Exchange Commission with new calls for legislation. The top Republican on the Senate Banking Committee, Senator Pat Toomey, writing in a tweet, quote, "Congress's failure to pass legislation creating regulatory guardrails for crypto trading, combined with the complete hostility and lack of transparency by the SEC, has generated a debilitated amount of legal uncertainty." The SEC reportedly met with FTX and former CEO Sam Bankman-Fried several times before the crypto firm filed for bankruptcy. Rumors have surfaced that SEC Chairman Gary Gensler helped Bankman-Fried with regulatory loopholes, trying to avoid certain filings, though that has not been corroborated. Representative Tom Emer tweeted, quote, "Interesting, Gary Gensler runs to the media while reports to my office allege he was helping SBF and FTX work on legal loopholes to obtain a regulatory monopoly. We're looking into this." SEC Chairman Gensler told CNBC in an interview last week, quote, "I think we've been clear in these meetings, non-compliance is not going to work. The public is going to be hurt." Now, Chair Gensler has repeatedly called on exchanges to register with the SEC and has said the agency is talking with crypto exchanges to get that done, though Coinbase says it doesn't see an immediate path forward to register with the SEC, saying though there's rhetoric, it's just not possible yet. I asked Chairman Gensler back in July whether rules for traditional brokerages should apply to crypto exchanges, namely where brokerages are barred from investing customer assets. Gensler suggested to me that that should be the case and rules should be tailored for crypto. Yet in this case, FTX was reportedly using more than half of its customer assets to lend to its sister hedge fund, Alameda. Back to you.
Yahoo Finance's Jen Schomburger. Jen, thanks so much for breaking that all down here on the regulatory front. For more on the existential problems for the crypto space, let's bring in Liz Hoffman, who's the Semaphore business and finance editor. Liz, great to have you here with us.
Good to be here.
Absolutely. So when we think about the companies, and we should note that FTX was an investor in Semaphore, when we think about the other companies that the FTX collapse takes with it as well, and some of the other issues on the number of lenders that it had reached out to, that it had partnered with, where else does this have broader ranging implications as well across crypto?
I want to say up front, it's Sam Bankman-Fried is personally invested.
Personally, yes.
I think this is like potentially, at least in the short run, pretty existential for crypto. The reports that have emerged paint this just incredibly interwoven, tangled web of finances that now is going to be the job of the bankruptcy court to figure out. I do think, there's been a lot of questions, is this a Lehman moment for the broader financial system? And I do not think so. I think sort of by design, the disdain that crypto had for the traditional financial system just means they're not that plugged into it. So I think this will be pretty self-contained within that market. But we've heard a lot of talk about a crypto winter. I would expect this to be something of an ice age.
We've also heard a lot of talk about, you heard Gary Gensler there, talking about regulation. Everybody in this industry wants to see regulation. I mean, how heavy-handed do you think that regulation could be?
Well, I think it's going to be more heavy-handed now, right, than had it been done on a clear day. This was a little bit of a regulatory jump ball. Was it right? In the same way that no one really has understood what crypto is. Is it a currency? Is it a security? Is it a commodity? It ultimately landed with the commodity regulator, the CFTC, which I think is probably the right place for it. But The SEC, certainly under its former chair, Jay Clayton, very much believed that these were securities just like a stock and bond and should be regulated with the same disclosures and the same sort of capital requirements for exchanges. I think it's massively overdue. It is a little hard to get your arms around as a regulator because you don't know quite what it is. But I think if you think of these, setting aside that it's a crypto or a token or a wallet, it's a brokerage, and there's a reason that they are A, not allowed to invest customer assets, and B, have to maintain like minimum capital requirements and disclose their balance sheet.
You throw on top of that SBF had actually worked on some of the regulatory language with SEC Chair Gary Gensler as well. And so how much further out does that perhaps push actual regulation? And what does that mean for some of the public equity companies, but even some of the newer projects that are just looking to retain or establish confidence as well?
The thing about financial regulation is that there's always this knowledge gap, right? In general, people in the industry are smarter and better informed than the regulators trying to regulate them. That gap is particularly wide in crypto because no one really understands it. And you remember when you saw Congress like interviewing questioning the tech CEOs, there was just like a real lack of understanding of a technology gap, right, to be fair. I think the right way to look at this is as an exchange, right? When you buy and sell a share of stock, you're not trading with the New York Stock Exchange. They put your order in a queue and they find someone who wants it. And that did not happen. It's been harder in crypto because there's this sort of chicken and egg, which is that you want a lot of liquidity so that people feel comfortable trading, but without the liquidity, it's hard to get there. And so exchanges have basically taken the other side themselves. And that's just an incredibly risky proposition because they are holding customers' cash. And the other thing here, there's been plenty of talk of potential criminality, and that will be someone else's call, but very clearly against the terms of service that FTX offered its clients. So right out of the gate, it's a problem.
How long before trust comes back into this industry? Are we talking years? Does it ever come back?
I think years. I mean, I think, it's kind of like if you go back to the dot-com boom, right? What now seems objectively silly looking back. There was a necessary reset. Those can happen violently as here and in 2001 or 2008. They can happen more gradually. But people would not touch dot-com stocks for years. The other thing, though, is that, a lot of the infrastructure that was built to support that dot-com bubble has been hugely valuable, right? It really helped usher in the technological age that we're in now. And so I think that'll be a question about what's the infrastructure, what's the sort of fiber optic cable of this crypto that does actually stay in the financial system.
All right, we'll leave it there. Liz Hoffman, Semaphore Business and Finance Editor, good to see you. Thanks for coming in. We appreciate it.
Thank you.
All right, that's going to do it for our Crypto Collapse special. Tune in to Yahoo Finance this afternoon at 3 p.m. for more on this fast-moving story. That's it from me, Brad Smith, and Akiko Fujita. See you guys later.